Good morning to everyone. I am Radhasri, Assistant Professor in Department of Commerce in Dr. SNS Radhasri College of Arts and Science. Today we are going to see about functional accounting. In that functional accounting, we are going to see about depreciation return on value method. Let me see about what is the return on value method. In depreciation, the main is the 8 methods have depreciations. In that way, we can able to analyze the second method is the return on value method. Return on value method is when we compare to the straight line method and the return on value method. The straight line method is the one amount is fixed for the depreciation. The each year the same amount will be repeated in the straight line method. When we compare to the return on value method, when first year when the machinery was purchased for 1 lakh, in the depreciation amount will be taken for that 10,000. That is the 1 year of the depreciation. The balance in the 1 lakh, the 10,000 is minus as the depreciation. Balance we having 90,000. The 90,000 is carried forward to the second year. In that second year, the 90,000 is the real value of that machinery in the second year. For that 90,000 only we want to calculate the depreciation. For that 90,000 we will calculate as a 10 percentage, means the depreciation will be taken as an 10,000. When we 90,000 and the 10,000 can be lessened, we can able to find out the 10,000 as the depreciation for the second year. Then third year, the amount of the depreciation is the 80,000. It is the category of the return on value method. The first year, when the machinery was purchased as a 1 lakh and the depreciation was less than by that in the 1 year, it will be taken by as 90,000 in the second year and it can be converted into third year as a 80,000. This is the value of the machinery when we return on value method as putting in that. The cost of asset minus the salvage value of the asset means scrap value of the asset. It can be calculated in the rate of the depreciation. The return on value method, the value of an asset after accounting and depreciation of the categories. It can be taken place by the value of the asset. It is taken by the when we are using the product, automatically it be taken place as the depreciation. In that way only the return of the depreciation will be taken place as the write down value method. It is sampling of the proficiency of depreciation as a fixed rate is applied on the book value or return on value of asset. This method is quite popular. It provides uniform charging of the charge for the service of the asset throughout the lifetime. When we compare to the income tax, it can be accepted this method for the taxation purpose only. In that way only it can be said that disadvantages of this method is silently completed by it can be asset have a reduced value. It is very difficult to calculate the rate. The return on value method, under this method, the value of an asset upon which depreciation is to be calculated is depreciation to be charged every year also goes on the declining way only. In the supposing way of the value of the asset rupees 2 lakh, as the rate of the depreciation is the 10 percentage per annum, the value of the depreciation during the first year is rupees 20,000 and the second year is rupees 18,000. The 2 percentage of the value of depreciation is be calculated for that way. It is known as the return on value method. In that way, the straight line method and the return on value method, when it is the cost of value is increases, the depreciation and repair can be taken place by the straight line method. In the return on value method, the total cost it be going in the straight day only, but the depreciation is automatically going by the straight correctly down of the year repairing charge and the amount of year return on value method has been calculated in the straight line method. This is the difference of the amount will be taken place. In the slide itself, we can able to identify the depreciation is going in the straight way. In the return of value method, the depreciation is going down. This is the difference. Straight line means the amount is going down. Return to value means the amount is be showing that in the causes of cases. Thank you for the listening of the return to value method.